You're such an asshole.
Asshole Consulting. This one took a little bit more research than I thought, and I found out why. The data isn't available for free. You could find it for $475 at the Mortgage Bankers Association. I'm like, fuck that. So I kind of pulled together some other research and proxied it, and I'll answer it, but this reminds me so much of economics, where it's like you spend 3 hours on the internet. Imagine before the internet. Holy shit. How long would it take to find one data point? You sit and sniff and you'd be a blood. One piece of data. It only took 3 hours. Hi, Aaron. Hope you are well. I had an economics-related question for you, specifically regarding interest rates. As you probably already know, the Fed is in the process of raising interest rates. They have been doing this by seemingly insignificant amounts of 0.25% roughly every quarter, although the intervals aren't exact. Rates are now between 1.5 and 1.75%. I know rising rates would place downward pressure on asset values such as stocks, real estate, bonds, and force the government to pay more in interest for its debt. However, this also affects adjustable mortgages and credit cards. My question is, do you think this will continue at the pace they say they'll do it by? Furthermore, how do you think this will play out, broadly speaking, in the economy? And what advice do you have for people in the 20s about how to deal with it, if there's anything at all? Thank you. All right, now, I'm going to show you why I'm the world's greatest economist. I'm being deadly serious about this. I'm going to explain to you why. Because I'm the only one that has the true answer to the questions you seek, my fine young friend. And the answer... Be quiet. Don't show this, no one else. I don't want you showing this on the internet or anything. The correct answer to all your questions is, I have no fucking clue. And any economist that tells you different is a lying sack of shit. Right? I have no idea. I don't know what the Federal Reserve is going to do. The Federal Reserve doesn't know what it's going to do. Now, what's happening, I mean, I'll tell you what I think might happen. I'm going to guesstimate what's happening here. Ever so in general, what's happening? The economy has been stabilizing, has been booming, but it's been stabilizing. There's less risk in the market because I guess the government's just going to put off a shit ton of money. This is also helped by the fact that the rest of the world's even crappier than the United States. And it's kind of like, cool, we got the golden printing press. Our dollars is worth as much as gold because the world will fucking buy it. So this has essentially bailed out the United States from the sins of 12, 15 years ago. 10 years ago. 10 to 15 years ago. The build up to the housing bubble. So what the Federal Reserve is doing in their chartered responsibility is to stop inflation, keep employment low, and all that other stuff. And what they're really concerned about is tightening labor markets, the tightening labor economy. Unemployment is very low. Now, all that being said, labor force participation rate, that's still a little high, so there's some slack left in there. I think, what was it, recently 800,000 people just entered the labor market. They're sitting on the sidelines. So whereas normally when people worked for a living and they were living off the government tit, they'd work. Labor force participation rate was here. And then it's like, oh, free government share. Now labor force not participating, people getting out of the labor market went high. Now it's like, oh, things are getting a little tight for people who are in the labor market. Now people are coming in. But in the olden days, a tight labor market, low unemployment, meant inflation was coming along, because now to get employees to come work for you, you had to pay them more. Labor costs went up, inflation went up. Oh no, not inflation, prices going up, what will we do? I don't know, I guess you just pay more, markets would naturally adapt. No, Federal Reserve's got to come into the rescue. So they have their FOMO, and they have their interest rates and the reserve requirement levers, and they pull, oh good, we have no inflation. So that's why they're doing it. Do I see that going on to the future? I don't know. I really, you're asking me to predict the future. Do I see it going on into the future? Yes. I think they're going to gradually ramp up the federal funds rate, interest rate, to just get ahead of any potential increase in inflation due to a tightening labor market. Keep in mind, the labor market is not jumping up anymore. We don't rapidly adapt anymore because there's so much government intervention going on, and that's why our economy is not only slowing down long-term economic growth if you look at going back to the 40s, but why it's also less volatile if you look at the standard deviation in GDP growth. That goes down, and the same thing with unemployment. That's going down. So there is statistically less risk. So it's not like unemployment is going to drop down to 2% next month. Oh my God, we've got to worry about hyperinflation. Oh man, people are making more money. We don't want that to happen. Love when they worry about inflation happening. It's like, yeah, because people are making more, so they should be able to afford it. What do I know? I don't have Keen's dick in my mouth. All right, enough. No rates. However, this also affects adjustable mortgages, credit cards. My question to you is, do you think this continue at the pace they say they'll do it by? Yes, I think they will. It's steady Eddie. They're policy wonks. This is more of a psychological question of what do you think about central bank economists? They're steady Eddie. They don't think outside the box. They're not nimble or fast. They don't like that. They like nice and steady and controlled things. Just boring people you don't want to have at a party. So I think it'll be, yes, steady as she goes. Furthermore, how do you think this will play out broadly speaking in the economy, and what advice do you have for people in the 20s about how to deal with it? I think it's going to be so slow and incremental, and they're so sensitive to, like, if the economy starts to slow down or unemployment goes up, they'll bring those interest rates right back to fucking zero if they have to. So they, despite galactic stupidity or external shocks to the economy, like the galactic stupidity of the American people buying houses they couldn't afford, the government has done Federal Reserve, Central Bank, and the government has done an amazing job of controlling the economy, and even though it should be a free market, and getting this nice standard 1.8% GDP growth. Oh, inflation was 1.4%. That's all right. That's all right. Unemployment came down 0.5%. I know. We're a good economist. It's so managed that I don't think that it's like, oh my God, do this tomorrow. It's going to be, the past 5 years, how nothing kind of happened. I think it's going to be the next 5 years, how nothing kind of happens, except unemployment probably, if it gets too low, they'll start jacking up interest rates a lot faster. But I think it's just going to be the world's gentlest, most boring landing we've ever had. And you can almost see it. It's kind of like that. Unemployment, GDP growth, inflation, if you include assets, but don't include assets, rather. So how would it broadly play out in the economy? It's going to be so timid, tepid, both. It's not going to jar the economy. Asset prices will normalize because companies can't just go borrow trillions of dollars and pay off that. They might continue to do that, but I think the asset bubbles in the stock market, they'll slow. Don't forget, people just got throwing money into their 401ks and IRAs too, regardless if the dividend yield's 1.3%, which it is. It's a whole whopping 2. Housing prices, you got to worry about demographics. Millennials got a ton of freaking debt. They're stupid. Interest rates aren't going to go up that much, but what it does affect, and here's where, as you point out rightly so, adjustable mortgage and credit cards, so short-term debts. And for people in the audience who may not be familiar with it, a lot of interest rates, you would say, well, the federal funds rate, or the interest rate set by the central bank and the Federal Reserve, well, that doesn't affect, that's not the credit card debt, that's not a 30-year mortgage. You're right, it isn't, but a lot of interest rates, short and medium term, are based on LIBOR or a central bank rate, like the federal funds rate. So when that goes up, all those go up, and any new bonds, or not bonds, bonds too, debts being issued at those risk maturity combinations, the interest rate will go up for that. So debt will get a little bit more expensive, credit will get a little bit more expensive, but as it speaks to the housing market, this is where I had to dig, this is where most of your money went, is I had to find out, okay, what percent of the market is adjustable mortgage? Mortgage Bankers Association, 5.7% on their latest report. That's nothing. I mean, you go back 2007, 2006, I was researching. My God, half the fucking mortgages written were subprime and Alt-A, or subprime in general. And adjustable, I know it was more, I think it was a full third, ARMs, but now it's 5.7%. So any adjustable mortgages being issued, it's such a small percentage of the overall market, I don't think it's going to have a huge effect on mortgages or housing values, like a tepid, slowing, dampering effect. But your 30 years and your 15 years, those are largely determined by risk and reward still, and maturity, and how long you're going to hold that mortgage. So I don't expect interest rates to be jacked up anytime soon. So it's we would need a jarring or something like volatility in the stock market where people are like, dude, what are we doing buying at a dividend yield of 1.7%? I don't know, Bob. I got enough money. I'm a little odd. Or people just saying, I don't want to pay that much anymore. Outside, again, another external shock that would cause the economy to slow down. It's just going to be steady as she goes. As far as I can tell, which I don't know because, again, I am the world's greatest economist. What advice do I have for people in their 20s about how to deal with it, if anything, if there's anything at all? If you can find the right house and the cash flow works, fine. Get the right house. Read my book, Bachelor Pad Economics. Don't buy in big liberal towns. Don't buy in states that have state income taxes. Don't buy in California and New York. And it really doesn't change any of the advice I'd recommend to 20-somethings or anyone else for that matter. I'm very Dave Ramsey-esque. Pay off your fucking debts. Don't borrow any more money. Everyone's worried about what is the economy going to do. It's like, okay, you don't control the economy. What do you control? Well, I can not borrow money. I can afford a $5,000 Kia Rio instead of a $25,000 Chevy Malibu new. You got mortgages? Well, you got credit card debts. You got a car loan. Why don't you pay off those mortgages and debts? Because your car loan is what, 7%? Credit cards, 20%. Your mortgage, 3.5%, 4%. You got to live. The stock market, I wouldn't invest in the stock market now. I don't want to earn 2% on my fucking money. Pay off your interest, your credit card debt, that charges you 15. Me, I don't have any debt, but for those of you that do have debt, which is most other people, that's the financial advice I'd be giving, regardless of whether the economy's doing this or whether it's just even keeled. I don't think there's going to be a huge recession anytime soon. Again, it would require an external shock. What could happen tomorrow? Don't say, it's never be in recession again. We're in the Goldilocks economy. I didn't say that. And yeah, it's really boring, frankly. It's just so freaking boring. It's what central banking should be. If the unemployment gets too tight, labor market gets too tight, and there's signs of inflation, you might see the Federal Reserve increase interest rates, and then it might get to the point where, all of a sudden the federal government, now their interest rates go up, their debt servicing goes way up, we have deficits, and now all of a sudden people are like, whoa, what's happening to financial solvency, U.S. financial solvency? Wouldn't affect your arms. The stock market could crash, and then you could have a asset or government treasury bond market crash, trigger fear that might cause a shock into consumer confidence that might send the real economy into recession. But that's about the only real threat I see, is rising interest rates, poking bubbles and popping them, and then that then triggering people to panic. But people are stupid and they don't understand that asset prices do matter, but it's really cash flow. But who cares about cash flow? That's boring, and who wants to listen to that crap anyway? So yeah, I'm sorry. I wish I could predict doom and gloom, and it could happen. And I wish I'd say good times are here again. It's just the most goddamn boring economy I've ever seen in a long time, with a whole new bunch of debt that we happen to got through Obama, Bush, and now thanks to Trump. So all right. Anyway, yeah, nothing to report. Terribly sorry, but don't be surprised if the world blows up tomorrow. All right, we'll see you guys later. Toodles.